Welcome everybody to the channel. I hope you're having a wonderful day. I thank you all for taking a bit of time to come watch this video. I'm Patrick Zimmerman, and today we'll be talking about two different stocks you can buy, either growth stocks or dividend stocks, which are often referred to as value stocks. Please subscribe to the channel and turn the notifications on if you would like similar content like this on your feed in the future. Additionally, it would really help me get more traffic to my channel if you left a like on the video, so I will ask you to please do that as well.
Skies are clearing up.
We're first going to talk about the growth stocks. I have it broken down into three different sections essentially. The first being the effect they have on your portfolio. The second being why the company places precedent on growing their business rather than paying dividends to their shareholders. And the last section is just one quick point on how investors evaluate growth stocks and choose whether or not they would like to buy shares of them. So growth stocks are most beneficial for young investors. You don't necessarily have to be in that 20 or 30 year age range, but I recommend trying to buy into these stocks about 10 years before retirement. The reason this is because you want to give them ample time to grow in the future and offer you the highest return on investment which you possibly can. Growth stocks also perform better in bull markets. This is when you see a plethora of people buying into the stock market. They're buying shares. It just seems like it's a green day most of the time and all of your positions are increasing. Growth stocks are oftentimes smaller, less established companies, so they have more room to grow and raise their stock price. As you can imagine, a time where there are a majority of people buying into the market rather than selling out, this can be a large catalyst on why a growth stock succeeds rather than loses value over time. On the other hand, in a bear market, when the majority of people are selling their shares of the company and the total market is trending downward from day to day, growth stocks have a difficult time succeeding. In this case, the fear that people have of losing their money which is invested is often greater than their belief and confidence in the growth company that they're invested into. Growth stocks oftentimes have a higher beta volatility. Beta volatility is a statistic that you can look up which expresses the fluctuations in stock price for that company. If the beta volatility is 1, that means that it tracks the broad market index almost exactly. If a stock has a beta volatility of 2, every time the broad market index increases or decreases, said stock will increase or decrease at twice the rate. Because growth stocks have a higher beta, this makes them more risky investments. The stock prices are subject to higher amounts of fluctuation, meaning there's a greater chance to lose money on your investment. But remember, that also comes along with the greater upside of substantial growth. So the reason a company often chooses to not pay out a dividend is because they have substantial room to grow in the future. In a little bit, we'll be looking at a graph of Tesla's growth versus AT&T's growth. Although Tesla deals with electric vehicles, they are both technically in the technology sector. Because a business recognizes its potential to grow in the future, they often do not waste their capital on dividend payments. Instead, they have a plan of how they can grow the company, which they believe will offer a higher return on investment than they could do so through dividend payments. Another reason growth companies have a difficult time offering dividend payments is because they are making so many changes from year to year. As I said before, they are not necessarily an established company yet. Rather, they are predicting they will be in the future. Because of these constant business improvements and innovations that they are coming up with and putting out to customers, they do not necessarily have a stable and expected track record when it comes to sales or the money which is coming in. As a result of this, they often have trouble predicting annual cash flow, which makes it difficult for them to offer a stable and expected dividend to their investors. The last thing I wanted to touch on regarding growth stocks is how they should be evaluated. Investors often evaluate growth stocks by looking at the PE ratio, which is the price per earnings, as well as the PAT growth, which is the profit after tax. Here's the graph of Tesla's stock price in blue compared to that of AT&T's. This is about from 2010 to 2013. Although this is from a few years back and Tesla's stock price has vastly increased since then, as well as the dividend yield of AT&T, it still offers the same idea which we're discussing. AT&T currently offers a dividend yield of just over 7%, which is pretty good in regard to their share price. But Tesla, arguably one of the greatest growth companies which you can invest in currently, has offered returns which are unmatched by that of any dividend company over the time frame shown. It's also important to note here that the green line, AT&T, is much more stable. You can see there are years where AT&T outperformed Tesla, and likewise, the end of the graph, Tesla is far outperforming AT&T. This is because Tesla, the growth stock, is so volatile, and the price over this 3-year period was swinging so much. There's years where they took huge dips, and years where they had huge gains, whereas AT&T's stock price pretty much stayed the same over the entire period. Just want to remind all you guys to subscribe to the channel and hit the notification bell if you have not done so yet. Last week I put up a video of a stock analysis of Enterprise Product Partners. I encourage you to go check that out if you're looking for a dividend yielding company above 10%. I also stated if that video got 5 likes, I would drop another stock analysis of one of my favorite real estate investment trusts. It got 5 likes rather quickly, thank you for that. Let's shoot for 6 likes on this video, so please go down and hit the like button. If we can achieve that, I'll be putting out a video on the strategy that I use to pick stocks for my dividend portfolio, and I'll also be showing you how I obtain the information on those said stocks. So dividend stocks are great if you are looking to build additional streams of income. Depending on how much you have invested into your dividend stocks, as well as the dividend yield for the stocks that you're invested into, determine how much money the company will be paying you in dividends. As I explained that growth stocks perform better in bull markets, it has been proven that dividend stocks perform better in bear markets. I recommend you keep this in mind for the future because although we haven't quite done so yet, the market has been performing so well as of late that it is bound to start trending down at some point. Who knows for how long, but unfortunately it doesn't consistently go up forever. The reason that dividend stocks perform better in bear markets is because when you're invested into a growth stock and the market has a downward trend, people are pulling out more money than they're putting in. There's no return on investment for you for that growth stock. With the dividend stock, you are still receiving dividend payments from the company, allowing you to grow your position or at least recoup some of the money you already have invested. Something else that dividend stocks offer is that they have a lower beta volatility compared to growth stocks, which means they are a less risky investment. I'm sure this is another factor in why they outperform growth stocks in bear markets. The reason companies offer dividend payments to their investors are 1, to attract new shareholders. Because they don't offer that appeal of vast amounts of growth in the future, they needed to find another way to attract new shareholders to their company. Although dividend stocks do not offer substantial rates of return through future growth, they can still do so by paying out dividends to the shareholders and rewarding them for being part of that company. Because dividend companies are more established, they have an easier time predicting their annual cash flow. This is because they don't need to put as much money into new business ventures, and they also have a long record of sales history and profit from year to year. In addition to looking at price per earnings ratios, when you were picking out which dividend stocks you would like to invest in, it's also incredibly important to look at the payout ratio. The payout ratio is essentially the portion of money which the company is using to pay out all of their dividends to their shareholders. If you find a company with a payout ratio below 65-70%, that's oftentimes very good, as they still have considerable amount of cash left over to either grow their business or pay new shareholders in the future. When choosing dividend stocks, you can also compare the stock price to the intrinsic value of the company. Say there's a company that you know is worth $100 and their share price is trading at $70. Then you can deem that stock as trading on sale, as the value of their stock price is currently $30 less than the value that you believe the company to be. This is a good indication of where the stock price should go, as its default price should be right around the same price that the company is worth. So this graph is the S&P 500, which is essentially the 500 largest companies on the stock market. There's a couple other qualifications that they need to meet. That line is in blue. The line in red is the S&P 500 Dividend Aristocrats, which is companies which belong to the S&P 500 and have increased their dividend at least one quarter annually for 25 years. The graph ranges from 1990 to 2014, and both lines start at $100. You can see how much more the Dividend Aristocrats outperformed the S&P 500 index. And I want you to take a special note of 2001. That was the year of the dot-com crash, when we were in an extremely bearish market. The Dividend Aristocrats continued to go up while the S&P 500 index began to go down. And now that you know the difference between a growth stock and a value stock or a dividend stock, you can determine which type of investment strategy is better for you. It may even be in your best interest to not solely hold dividend stocks or growth stocks, but to own a mix of both. If you're looking for consistent income and cash flow, dividend stocks may be the way to go. Or if you have some extra money lying around, maybe it's just in your savings account and you already have an emergency fund established and you don't need it for anything, you can invest in some growth companies and expect a big payout in the future. Please go down and smash the like button if you enjoyed the video today. We're shooting for 6 likes and I will release the video on my dividend strategies. Also, don't forget to subscribe to the channel and turn on notifications if you liked the content and would like to be notified when I put out a new video. As always, I'm Patrick Zimmerman. Thank you for your time and enjoy the rest of your day.